Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full. A bubble exists when incomes can't sustain the asset prices. So this is an extraordinary thing here, $1 trillion in capex against $20 billion of revenue. We've pointed it out before, it just doesn't line up. Hello, everyone, and welcome to this episode of Finance U. I am your host, Dr. Chris Martinson. Today, I'm going to be doing this solo. Paul is traveling, so a little bit of a solo romp through some of the data. And I'm calling this one, by the way, Creak Pop. This thing is going to blow. So again, everything I do is in service of helping you achieve financial awareness and then hopefully freedom. Because, listen, this next thing, when these markets finally blow, my belief happens to be that this is going to be very painful for a lot of folks. So that's why we have Peak Financial Investing, why we direct people to Paul Kiker's firm for really excellent, amazing service and a risk-managed portfolio approach, which we're going to hear from Paul about that later because he had recorded something for us for that. Well, so that will come a little bit later on. But first, we're going to set this up. This is astonishing. This is a creaking sound right here. Japan's 30-year bond yield has now hit the highest level in history, and it didn't sort of creep up there. As you can see over here, came all the way down to, look at that, that's 0.5. So that came darn close to zero, and it went from zero all the way up here to 3.216 at last count here earlier today, which is the 27th of August. But look at the pace of this climb, blowing past 0.5 to 1 to 1.5 to 2, 2.5, 3, and on it goes. So it's the pace of change that gets you. Not always just the absolute amount is 3.216, too much to pay for the Japanese government for 30 years. The answer is no, it's way too little. Who in their right mind would loan Japan money at 3.216% for 30 years? But still, what's on the other side of this? Somebody is blowing up. I suspect that there's some big Japanese financial firms in particular, maybe some banks, maybe an insurance company, who knows, that's on the wrong side of this and is absolutely blowing up. And as the great Martis points out here, there's the link down below. Here you can see that 30-year yield spiking like this. This other line down here is the official interest rate of Japan's Bank of Japan. So that's a short end. So when the central banks, the Fed, Bank of England, Bank of Japan, when they set a rate, they're setting that for overnight money. That's if you had to borrow money overnight, what would the annualized rate of interest be on that? So it's a very, very small amount because it's just one night out of 356. But when you analyze that, it comes out to whatever that is, just under 1%. So they're cornered. They've lost the handle on this whole thing. You can't have that massively widening spread between your short paper and your long paper yields. So this is getting pretty dicey. And if we look at Japan on a slightly longer time frame here, so this is a chart that starts back in 2007, sorry. And you can see here, this is their 10-year, 20-year, 20-year, 30-year, and 40-year. They're all trading pretty close to each other. They're all blowing out. So it's not just the 30-year paper. It's the 40-year. It's the 20-year paper. And that 30-year paper there is trading at an all-time high in this series. So all of them are blowing out. What is going on? Well, this is popping sounds over here, creaking and popping. Japan has lost control of the long end of its curve. Now, it may have to step back in. The Bank of Japan may have to really start pumping the purchases up. It may have to get in there and print more yen, do what central banks do, which is try and control the uncontrollable that was created by the interventionist policies of the prior years of the central banks, and fix that by intervening again. Interventions beget more interventions, and they become larger and larger and larger over time. So that's just a observation that we can hold based on the last 20, 30 years of watching all of this. UK, their 30-year, they call it a gilt, not a bond, a gilt, G-I-L-T. Their gilt yields are exploding higher, now at 5.624%, their highest level since 1998. So they're about to party like it's 1999. This also is showing extreme trouble happening in the long bond for the UK. So Japan and the UK, a little bit of trouble. And so here you can see what that bond yield has done, just exploding up of late. Now, the United States, our 20-year TLT bond, as it's called, this is the worst bear market in U.S. history for the U.S. TLT. You can see here the blue is the index. The TLT is an index, and it just like marched steadily higher for a long, long time. But this drawdown starting about 2020, 2019, this is 38%. It's the biggest, worst bond drawdown in history. Now, how did that happen? Well, it happened because the Federal Reserve, coming up through 2009, 10, 11, 12, 13, 14, 15, they drove interest rates to zero. So that really was hugely supportive of bond prices. Once they started reversing that a little bit and taking their balance sheet and starting to reduce it a little bit, bringing some of the buying pressure back away from these bonds as well, raising interest rates on the short end, put those two things together, and now all of a sudden everybody who was buying those bonds finds themselves not just a little bit, but pretty deeply underwater. So this is all a lot of creaking and popping sound here within the long bond market. It says that investors don't want to lend long to governments under these circumstances. So what are these circumstances? Well, we have really, really terrible fiscal policies going on in almost every major country. We've got some really bad, huge, enormous debt problems that have built up that look, frankly, unaddressable, deeply, actually unaddressable. So with that, let's cast over and look at France. This just came in today. France now is facing catastrophic $2.85 trillion of debt explosion meltdown as their finance minister warns the country is heading for an IMF bailout, with Emmanuel Macron's government on the verge of collapse. Now, here's the funny thing. When you get an IMF bailout as a country, it's not a bailout. When Goldman Sachs was given 100 cents on the dollar for the really terrible collateralized debt obligation bets they made back during the great financial crisis, that was a bailout. They got their money back. When the IMF comes in, it's not a bailout. What they do is the bankers who fund the IMF, the bankers, of course, print money out of thin air. Clickety-click, and they give it to the IMF, and then the IMF gives it to France to help it with its debt explosion problem, but they're going to take something in return. Something like a productive asset, like, I don't know, parts of your utility grid, maybe your ports, your airports, anything that's sort of cash flowing that's an actual asset is going to be collateralized on the back end of that bailout. A bailout is when somebody just gives you money to make you whole. That's what bankers get. Countries don't get bailouts. Countries get additional debt with additional strings. But here's the fun part, because you and I know this because we study these things carefully, right? When banks loan those monies out, whether it's for a mortgage, whether it's for an automobile here in the United States, whether it happens to be to another country for some big project they want to do, the banks literally create that money out of thin air. That was something that the economist Richard Werner figured out empirically within the Bank of Japan system, but that's something the Bank of England even managed to figure out in 2014 by finally studying it. Of course, the Austrian economists knew that forever and ever and ever. I had that in my original 2008 crash course as a mechanism. When the bank loans you money and says, oh, you would like to get a mortgage, and they go, here you go, here's your $500,000 of mortgage money, where did that come from? Well, it came at the moment they clickety-clicked and said, here you go, because your new liability of a $500,000 mortgage, that's the L side of the balance sheet, came with an asset, which is the $500,000 of cash. The debt and the asset come together. Well, at any rate, we're going to see some explosions over there in France. That's kind of interesting. And I'll show you Germany's not in really good shape either. But first, this is all coming at the same time, watching the long end of the curve, right? The 20, 30, 40-year paper blow out a little bit. That's going to have not good effects on housing, which keys off of the long end, usually, sometimes a 10 years, sometimes a 20 to 30, depending on where we're talking about. But right now, the number of homes for sale in the United States is approaching the great financial crisis levels. There are over 500,000. There's 511,000 homes for sale right now, and these are single-family homes. And the only time we were above that was right here in the context of the great financial crisis here, coming in through 2007, 8, 9, and into 2010. So at any rate, that's a big stress in the system right now. We know that there are a lot of homes for sale. We know that we're seeing home price erosion across a number of markets in the United States. These are all fairly worrying signs for the economy as a whole, because the economy is very keyed off of consumers and real estate. Those are two big, giant drivers. What's interesting here is that we're supposed to believe this time is different. And this is actually looking at this is interesting. I like this chart. Good job, Econo Visuals. It's showing the relationship of the S&P 500 to the commodity index is a ratio. And it's just hit a record high. Higher than at the dot-com bubble, higher than the COVID-19 pandemic spike bubble, higher than any other time we've seen. This is the tech boom of 2025, and we're hitting a level of 350 when you would say, wow, commodities are expensive when they're down here at a ratio level of, I'm going to call that 10, right? But commodities are ridiculously underpriced relative to stocks. We saw that at the dot-com bubble here in 2000. So that hit a high of about 250, but then crashed all the way back down here to just under 50. And then again, up, a big crash down, and back up again. So this is pretty interesting for everybody who's interested, like I am, in hard assets and commodity investing, all of that. This suggests that it's not different this time. This is going to revert to the mean, that if you were in a position where you're thinking, not totally excited with what I think the future potential returns are within the equity markets, then this would be a great time to sort of rotate out of that and into commodities. Now, one of the reasons I think we have a giant tech bubble right now is because I just can't figure out what the business model is of AI. So before I get to that, I do want to go and talk about what's going on in that AI center, and got a really incredible chart to look at there. But before we go there, first, we're going to take a quick break to hear from one of my favorite sponsors. The markets are a ticking time bomb. Volatility is spiking, trade wars have broken out, and most investors are sleepwalking into disaster. Many portfolio strategies perform poorly during times like these. At Peak Financial Investing, however, we don't gamble with your future. Our registered investment advisory connects you with battle-tested wealth managers who reject outdated models and embrace active management, strategies proven to navigate chaos, and who aren't afraid to discuss things like the great taking, or maybe the importance of protecting your wealth with gold. Without the right approach and with the wrong advisor, you're risking, well, everything. Don't wait for the crash to act. Visit peakfinancialinvesting.com right now to schedule a free consultation and discuss your particular situation. Take control of your wealth before the markets take it from you. Again, that's peakfinancialinvesting.com, and I'm Dr. Chris Martinson, urging you to act now. Welcome back, everybody. Now let's take a look at that chart we were going to talk about, which is this one. I like how Zoomer put it here. That's at ZoomiZoom over on X or Twitter, whatever you call it. $1 trillion of AI CapEx spend against $20 billion of revenue. AI is in a bubble. So yeah, sure, we can see that AI revenues have been growing pretty smartly here from, from practically $0 billions in 2023. Here we are in a little over midway of 2025, and we're already closing in on 20 billion. So it sounds like a good growth story, but I think you can see it's not going to necessarily go exponentially forever. If you said we have to spend $1 trillion of CapEx to get 20 billion of revenue, the problem is that means it's going to take you 50 years for the revenue to match the amount of CapEx spend you had, capital expenditures, CapEx spend you had to put in order to achieve that 20 billion. 50, you don't have 50 years. These machines are going to be replaced and outmoded every 5 years, give or take. So this just shows an extraordinary bubble. Remember, my favorite definition of a bubble is when asset prices rise beyond what incomes can sustain. whether we're talking tulip bulbs back in Holland in the 1600s, whether we're talking railroads in the United States in the early 1900s, whether we're talking Florida swampland back in the day, whatever the story is, a bubble exists when incomes can't sustain the asset prices. So this is an extraordinary thing here, $1 trillion in capex against $20 billion of revenue. We've pointed it out before. It just doesn't line up. It just doesn't. As well, we have to be cautious at this point in time because we're seeing that the leading economic indicators are also talking about that there's a recession. I think based on the charts I have, the recession is actually already here. And here we're looking at the leading economic indicators. And every time you see these things have slid down a little, you had a recession. And this starts all the way back in 1963. And then it goes up, and then the leading economic indicators slide down. Got a recession. Leading economic indicators slide down. That was the double dip, a recession right there. Leading economic indicators slides down, 91. Oh, there's a recession. Nothing for these little tiny downs here, but here you see the LEI slips down, recession, climbs back up, slips down. That's the great financial crisis. This is, and that COVID was just a blip. This is the largest, most sustained downturn we've had since 1963 that hasn't resulted in an official recession. Given everything we've been tracking over the last few weeks, we have what apparently is very weak labor data. We have very weak consumer data. We've got very weak housing data. These are all consistent with actually already being in a recession. I think based on this chart, we probably already are in a recession. It just hasn't been officially named yet, which makes the frothiness in stocks, the ebullience, the widely e-coyote levitationalness of these stock prices right now a little bit extra concerning, because there should be some correlation between and causation between stock prices and whether or not the economy is actually expanding. Now, something's got to give. We know this. We know that there's been a lot of sort of complaining out there by people who are getting just eviscerated by incredible amounts of inflation. Honestly, worse inflation than even in the 70s. We just saw Powell say that, well, he's very open to the idea of lowering interest rates again. That could give him sort of an Arthur Burns moment. Arthur Burns, the Federal Reserve chairman who was in charge back in the 70s when that major raging inflation came along, because he didn't want to take the punch bowl away either. So maybe Jay Powell's going to make a Arthur Burnsian sort of a mistake here, or maybe it'll be his predecessor whenever that person comes in who continues the mistake. Wall Street Apes here reporting, quote, American says 15 years ago he bought this home that he's giving this little speech from here for $130K, worked his years rebuilding it from bad condition, putting over $120,000 worth of repairs into it. The city just reassessed his property value. His property taxes are now tripling, and he can't afford his home anymore. Does that make no sense to you either, that you would be punishing people for improving their homes? That's what this guy did. He buys a home, puts his sweat and tears and money into it, and because it's now worth more, the city says, oh, well, you have to pay us more money for that. That is, incentives shape outcomes. If you continue to punish people for improving their properties, they will stop improving their properties, right? And that doesn't benefit anybody. Now you have kind of a shabby town. It doesn't work. I mean, the property taxes, the way they're administered in this country, in the United States, are amongst the most abusive of all possible taxes, because A, they're taxing an unrealized gain. Hey, your house was worth this much. Now it's worth this much. You didn't realize the gain. You didn't sell it. Well, you got to pay us tax on the difference for the rest of the life. It could be that you might put this guy, if he puts his $100,000 of repairs into this house, he may end up paying $300,000 of taxes on the increased value that those repairs put into that over the life of that home if he stays there for the rest of his life. It's just crazy. It's a crazy system. It's abusive. Doesn't work. There, I'll get off my soapbox, but we're going to have to do something because this is getting to the breaking point. All right. He said, they did come along and reassess it. My taxes are going to triple. I did all this work on my own. I busted my ass inside and out, landscaping, effing roof, gutted half the place. It's getting to the point where I can't even afford to live in a house that I bought almost 15 years ago. The price of everything is doubled. Vehicles double. You know the deal. Groceries double. Insurance is double, including vehicle insurance. End quote. Absolutely, dude. It's getting to be very, very difficult. Now, this is why all of us are going to have to plan for much higher rates of inflation than you typically find in a retirement planning vehicle or in talking with an ordinary broker somebody who doesn't understand and or foolishly believes the CPI inflation is a true measure of inflation, because it's not, right? It's not even a decent place to start, because CPI tries to average inflation across the whole country. But an 18-year-old living in Topeka is going to have a very different experience from a 70-year-old living in San Francisco. Just different experiences, right? Different costs of living, different structures. And by the way, if you're 70, I don't know, maybe you have more prescription drugs. Those might be rising at a much higher rate than average inflation, et cetera, and so forth. So at any rate, whatever the CPI is, throw it out. It's hedonically adjusted. They use substituting, weighting adjustments, all these statistical tricks to try and make it look as small as possible, because that's what the government does. The government likes to pretend that it's doing a good job, and one of the ways it does that is by telling you inflation's less than it is. Who are you going to believe, me or your lying eyes, says the government statistician. And the second reason the government wants to limit inflation is because, of course, they have to give these cost of living, COLA, adjustments on things like Social Security and other income stream payments. So they have an incentive to keep the stated rate of inflation as low as possible. That's the floor. That's the lowest. So if the stated rate of inflation is 3.6% officially from the government in the CPI, you can add at least 2 points to that, make it 5.6%. Feel free to double it if you want, but it's somewhere in that zone, a 2x to a 3x. That's probably reality. And by the way, more inflation is about to come. As I've told you many, many times, energy is the master resource. All capital letters, THE, the master resource. On that front, there's all these pushes that are coming along to electrify everything. I live in the state of Massachusetts. The new building codes say you have to, if you do a new building for a house, you have to install an EV charger, because as we all know, everybody's going to have an electric car. Maybe. But still, it's in the code, so that's a whole extra 60 amp panel. Costs thousands of dollars to have all that extra carriage of like the piping of the wiring to come in, and the panels and all that circuitry. Everything has to be beefed up to accommodate that. What we're not doing in this great state of mind is also expanding electricity production. Unusual Whales pointing out just how crazy this could be. Quote, if every U.S. household went all electric, that's replacing gas-powered heating, hot water, and vehicles, the monthly consumption would triple from 875 kilowatt hours to 2,803 kilowatt hours. Such a seismic shift would overwhelm large swaths of the existing grid without massive upgrades. And this is per Bank of America. So they break it down there according to colors. You got other, whatever that is, EVs, water heating, and space cooling. Obviously, space heating, that's a big deal. Water heating's a big deal. It's all a big deal. It's not going to happen because already we're facing extraordinarily high and surging electricity prices here. And there's a series of headlines that sort of blame it on this and that. But, and is it going to be politicized? Can you blame Trump? Can you blame Republicans? Can you blame Biden or whoever? So we have surging electricity prices here. And so the reasons for, let's put in a chart. Charts are easy to see. Whoa, baseline to 100, average price for electricity per kilowatt hour in the average U.S. city here bounced along, really didn't go anywhere from 2016, 17, 18, 19, 20, 21. And then all of a sudden we start slapping these data centers in. We had the generalized inflation as well. And together, those two things conspired to drive it from 100 to 138. That is a 38% increase in electricity prices in just the past, call that 4 years, when we had whole chunks of 4-year periods where it really didn't go up all that much. Now, as we know, this is going to be just yet another pain point for a lot of people out there. Anybody on a fixed income, now you have the price of steaks going through the roof because cattle prices are all-time high. You have the price of food up high, still going higher. You have prices for insurance going through the roof, and now this too, electricity costs as well. What happens when your electricity costs get out of control? Well, so we can actually ask and answer that question by turning to Germany and noticing that the German industry, in particular their energy-intensive industries, that would be steel, cement, glass, things like that, things that take a lot of energy. those industries have shed almost 250,000 jobs as the downturn in Europe's largest economy is picking up speed. Deindustrialization, right? So they're deindustrializing rapidly because they did some very foolish things around energy. Energy is everything. If you understand the energy part of this equation, the economy is actually a second-order derivative of energy. So on that front, I mean, we can see it really clearly in this chart, this table here. Look at this unbelievable spread in electricity costs. Ireland at the top, 52 cents. As we spread across all the other countries, you got Turkey, the UAE, India, China at 8 cents a kilowatt hour down here. Oh, isn't that interesting? That's where some of your wealthiest and most industrialized countries are actually parked way down there. Up here, you have the UK rapidly going through a social collapse at this point in time. Italy is struggling along. Belgium struggling. Germany's struggling. There's a lot of struggling going on. You see France way up here, and this is pretty clear. Now, what's funny is USA has an average of 17 cents. I can tell you my state, my fair state of Massachusetts, is parked there at about the 26-cent level. And by the way, if you're in California, I'm very sorry, but you're parked just under Germany. I think you're at 37 cents here. These bad policies have consequences, and you should just be aware of them. Maybe there's something we can do about this over time, but these bad policies will ultimately have consequences. Here we can see that home prices over these series of months, starting in October of 24, November of 24, December of 24, and then January, February, March, April, May, June of 2025. These are monthlies. So yeah, here in New York, they're still experiencing here in June of 25, let's call that a 7% increase. But a couple of months ago, it was closer to an 8% increase. So the rate of that's slowing year over year is starting to nose over. Does that make sense? You can see that same basic behavior. All of these cities are nosing over, and some of them have nosed into negative territory. That would be Miami, Denver, San Diego, Dallas, San Francisco, Tampa. On this chart, Tampa really down, starting to nose over into negative territory. This is the composite 20, and here, let me take myself out of this very quickly. So you can clearly see this is eroding pretty rapidly here right now. So combined with 500,000 plus 511,000 homes that are now for sale and eroding home prices, we clearly have a housing downturn on our hands, which is also very recessionary. We see here in Florida, which was one of those harder hit places in Naples, Florida, condo prices really took a nice nice depending on how you look at it, pretty stable up until about 2020, and then took a big old ride up and is round tripped pretty much back to where it started. And so that's going to be real painful for anybody who bought up here at, let's call that the $750,000 level, and finding that the average condo price is now $450,000. That's a pretty staggering loss right there. So, yeah, that's pretty impressive right there. Just beware. That's what I'm seeing on the recession front. Very quickly turning to metals, I was a little bit surprised. Steve St. Angelo on the SRS Rocco report dug this up, found in the SLV iShares Silver Trust. So if you're going to buy silver, I don't recommend SLV. I don't recommend GLD for gold. It's paper silver, it's paper gold respectively. If you're going to buy silver or gold, buy silver or gold. I would give the same advice to the Saudi government, but what's interesting is, what did he find? He found that listed here on the 13F, from August 14th, the SLV is reporting now that the Saudi central bank has stepped in and picked up, closing in on 900,000+ shares of this SLV tracking. So somehow the Saudi central bank is buying SLV. You heard that right. Silver, I believe, is going to go through an extraordinary explosion at some point here, just because of the supply-demand fundamentals, but also seeing other big players starting to pile in. If you haven't seen the interview I just did just came out recently with Vince Lancy, we talk about this, we talk about gold, we talk about silver, we talk about the large geo-macro things that are sort of breaking right now, that are starting to really say commodities, gold, silver, now is really probably, we're getting close to them having a day in the sun. On the other side of this, on equities, though, we would say, wow, stock valuations hit a new all-time high. What have they always done? This is going back to 1900, by the way, real long-term chart. We have to go way back to find an analog or comparable to how ridiculously expensive stocks are today. When stocks hit an all-time high in 1929, for that period of time, obviously that was followed by a big, crushing, long period of losses. Climbed all the way back up to hit another new all-time high of these valuations, which, by the way, is composed of trailing PE, forward PE, the CAPE, the PB, price to book, price to sales, enterprise value, EBITDA, Q ratio, all this stuff. So it's a big old summation of all the ways you could sort of think about values and valuation. Got up 1965 and then fell all the way back down. That was pretty much dead. This was dead period for stock investing. That's when you had, during this whole period of rinsing that out, is when Barron said stocks are dead forever, ran the covers. And then we ran up to 1999. What happened right after that? Right, we had those big punishing downturns, and we've been slapped and smashed all the way back up there again. Obviously, pretty good chance that this time isn't different, that we're going to see that investing at this level here is going to be, at best, a long wait to get back to even. And doesn't matter, though. People have been conditioned. This has been one of the most extraordinary buy-the-dip moments in history. So if you just bought the dip, you would have gotten one of the best returns back there. So this is average S&P return in the session following a down day. If there was a down day, you just bought it. Bought it at the end of the day. Day was down, I'm buying it. I'm buying that dip. You had the best return in over 30 years if you pursued that particular strategy. So people have been conditioned, of course, to buy the dip. That all works great until buy the dip doesn't work, and then things get a little spicy. To show just how crazy it's gotten, though, just in the last few years, just really in this most recent era right here, let's look at Walmart very quickly. Sven Henrik pointed this out. He said, look, some charts just need to be preserved for posterity, he writes here. The year is 2025, and we have a retailer, Walmart, with a forward PE of 32.6 and a PEG ratio of 3.69, and that's quite the monthly MACD down there. Oh, look at this thing starting to roll over. Oh, that could be so ugly. And by the way, that monthly MACD is very concerning looking here. Let's look at it this way. Here's Walmart prior to that big run up. 2024, it goes from 50 to $100. If Walmart goes back to 15 times earnings, which is pretty ordinary for a retailer, it's going back to $50 a share, which is a 50% haircut from here. So as crazy as that is, nothing compares to NVIDIA. This is NVIDIA's stock price. This is crazy. It just is. And by the way, it was busy going through a big downturn here, and it got super rescued here. And now NVIDIA is, by all accounts, if it was a stock market all by itself, I think it's now the third largest stock market in the world by market cap. It's crazy how big it's gotten. We're over $4 trillion of value market cap in this thing. Obviously, for this to continue is going to require lots of things to be priced to perfection. Things are never quite different this time, and it won't be different this time. This is one more measure of just how crazy things are. This is the Shiller PE ratio. We're sitting here at a reading of 38.95. We can compare that to 2000. Otherwise, we don't have any comparisons. We've never been this high before. So these are all measures to say, look, we have some recession indicators in the pipe. They're pretty strong, right? The LEI, we've got the employment data, we have the housing data, all that, all suggesting, look, it's possible we have a recession here. But one's coming anyway, they always do. We have a stock market, secondarily, that's not just priced for perfection, but is either close to or at an all-time high of value, of price, compared to all of history. So you got that. Those are two kind of awkward pieces of time right there. So what do you do about that? I think you should be considering, if you have money, it's in the market, you're going to be in the market, I get it, but it needs to be run with a risk-managed approach. Very few people out there run a risk-managed portfolio. It's more complicated, it takes more work, but boy, is it worth it. Most of them out there are what we call passive approaches, right? Passive investing is, well, I contribute to my 401k and it buys into the major indices, right? That's passive. Risk managed says, hey, where are we? How do we set some floors and levels? How do we make sure that if certain things are breached, using very, very precise formulas and all of that, what happens next? Secondarily, you should be asking the question, given where I am in life, how close I am to retirement, how far away I am, how aggressive my investing strategy is. You need to have an approach that maps into your circumstances to give you the best possible chance of success, meaning you don't run out of money in retirement, that you don't face an extraordinary drawdown that you are forced to sell into that takes years, if not decades, away from your overall plans. That's what this means. So with that, we'll turn it now to Paul, who recorded this earlier, and he's going to talk to us about how he operates a risk-managed portfolio.
You've heard the term past performance is not indicative of future results, and that is so true. And the time of which you start makes all the difference. And those are forces that are so far outside your control. So what we're going to do is show exact same strategy with different starting years. So the program that we use in the retirement planning process uses actual historical returns, which are called rolling period analysis. So the first thing I'm going to start with is somebody that's the age of 70. We're going to assume that they're going to live to the age of 92. And we're going to start with 1926, and we're going to go forward 22 years. Start with 1927 and go forward 22 years, 1928, and so forth. So we can actually go all the way back to the year 2000 and go forward because we have data up to 2003 with actual historical performance. Now, what's fascinating before I get into this, our whole industry uses Monte Carlo analysis with all of the financial planning programs. And it's really fancy, it's really sexy, it's all this mathematics, and it's one way of dealing with an unknown future. But the problem is it uses so many calculations that are out there, it dilutes historical reality. And what I have found, just anecdotal, not full evidence, I haven't done the mathematics behind it, but in my experience of comparing plans to the actual historical rolling period, to the Monte Carlo analysis, it overestimates your probability of success by about 15%. So now that I've laid that kind of background, let's dig into this just a little bit. And so the first thing I'm going to do is just quickly take you through the data that we put in there. So in this scenario, I'm assuming that someone needs $100,000 a year of income, and we're going to look at 3.5% inflation. So for 22 years. So in each scenario, we're going to increase that cost of living by 3.5%. And that's the reality of what I've experienced. I will tell you this. In 26 years of working with retirees, starting in 1998 in this industry, it's not the market declines that, don't get me wrong, they can wipe you out if you're not prepared for it. But not planning for inflation is the one thing that causes people the most trouble. So if you're 70 today and you need to live on $100,000 in income, by the time you're 92, you're going to need $296,000 in income just to maintain the same standard of living. Okay.
Yep.
By the time you're 80, you're going to need $141,000 a year in income just to buy the same amount of soup and beans. And if you're healthy and you're 80 years old, you're still traveling a lot. I mean, I have people that'll tell me, well, I won't travel as much when I'm 80. If you're fortunate enough to be healthy, you're going to travel just as much, if not more. Now, also taking into consideration Social Security, I just picked a number, $2,000 a month. But in our retirement analysis, we run a 2.5% increase in Social Security because the unspoken little evil secret is that Social Security adjustments, and I would say prior to 2020, I would say it was 30% less than the actual cost of living. I would say it's half the actual cost of living now. So I'm undercutting that by 30%. So then I'm taking a portfolio. I just picked $2 million. I can take different portfolios, put in tax rates and fees, and I'm doing 60% intermediate government bonds and 40% treasury bills. So in that
This is very safe. This is this person's all on fixed income. Very good.
All on fixed income. They're scared. They don't know what to do. They don't want to pay any fees. They put 100% in there. Now, the average person is going to say, hey, I'm 70. I've got $2 million. I can live on $100,000 a year. I don't need to carry any risk. Let's take a look at that throughout history. So when I look at this, it does the calculations every single time. So it takes a few minutes to get through there because computing power is cheaper than storage power. So what it comes out with us in this situation is it tells us that if you live to 92 and inflation is 3.5%, you get a 65% probability of success. and
Ouch.
a 35% probability of failure. Okay. So I've had people tell me, look, I won't live that long. Okay. I've got clients that didn't think they'd live past the age of 82 that are 93 now. And because I was persistent enough and helping them plan for the future, they've not gotten themselves in trouble. But this is what's really powerful right here. So when we go back, okay, remember, this is a very conservative portfolio. It's all in fixed income. So if we go back historically, this is the actual account balances that this individual would have had in this hypothetical scenario if today was 1981 and they went forward. Well, Chris, what was the common theme of 1981? We had really high interest rates in 1981, didn't we?
Mm-hmm.
So that was the best historical period that you could have been in.
Yeah, because you could have got 10-year bonds at 14%, but if we're assuming inflation's 3.5%, your green line goes up. That was awesome.
You're exactly right. So perfect scenario, right? This is other periods like 1973. We get down to 1963. That's the actual, so same strategy, different starting year, and a different following economic environment.
Okay, so if it's a green line, it means our strategy succeeded. We might have had in that green line a little less left over to distribute to our heirs in probate, but we made it.
Correct.
Without running out of money. Okay, because it's a green line. All right.
Yeah. So green line is success. Red line is failure. Okay. So when we get down in here in 1933, okay, after the worst decline of the Great Depression, interest rates were low for a long period of time. You would have actually run out of money at about the age of 90. So you can see, because it's fixed income, this is a slow decline. But the worst period would have been if today was, let's see here, if today was 1941, that same investor would have outlived their funds. Okay. Now, for that individual, let's assume that they own their house, cash and paid for. You can use that as a reverse mortgage, but you're still looking at a situation to where you run out of money before you run out of life. So that's one scenario. So that's a safe scenario. Well, let's go look at other scenarios. So if $100,000 a year, $2 million, intermediate term government bonds and treasuries, you've got a 65% probability of success if inflation is 3.5%. If you go up to a moderate growth portfolio, and none of these are risk managed, okay, risk management is an overlay. The reason we don't run risk managed in the historical back test is, what if a nuke goes off in Los Angeles, right? Nobody can prepare for that. God forbid. Sorry, I had to pick a city. So, or if the new Madrid was to go off in St. Louis, we can't prepare for that. So I still want clients to be able to survive a major decline if it's an event that we can't prepare for. So here's the counterintuitive part, Chris. There's so many people that retire on one side. They say, I'm scared of the market. This is a crazy game. I don't want to participate in it. I don't understand what's taking place. So I'm going to go all into fixed income. They think they're making the right decision, but if inflation continues going forward, they're actually putting themselves at a greater percentage probability of failing than somebody who does a moderate growth portfolio. So let's take a look at this one. We're going to have some more variability. I haven't changed anything in this scenario, except we've gone up to 70% equities in a modern portfolio theory portfolio and 30% in fixed income. So what we want to do is we go take a look at that spaghetti chart. Guess what? A completely different number one year is 1975. The problem that I'm seeing right now, Chris, when I talk with people and when I look at the industry, at what I know, I have a lot of really good relationships with advisors that are on the buy and hold modern portfolio theory passive side. And I have a lot of conversations with them, asking them, so, what are you showing clients and what's the data? All of the data that they're showing clients and all of the information that they're giving is assuming that the next 22 years or 25 years is going to be the same scenarios to what happened in 1975 going forward, or 1979 or 1980. These are all of these starting years. Okay. And then you've got 1976. You've got 1977 and even 1984. So that's a highly unusual period of time throughout history. So remember, exact same strategy, different period of time, different economic environment. If this was after the Great Depression in 1932, you're okay. But what if today is 1929? That individual that's 70 years old would have run out of money by the time they were 88. If they were 60 and retired, they would run out of money by the time they were 78. So you can see 1929, 1928, 1927 are the historical periods of time that it would have taken somebody out. 1926, 1937, 1931. And look at that. 1999 was successful, but barely.
Barely. Yep.
So, one of the ways that we deal with it is to go back and show clients, look, based on your situation, the income that you need, the assets that you have, we count rental property income, we count pensions, we count everything that's there. What is your trajectory and what is your risk? And it's all about balancing out that risk and reward. And once we get a resilient plan in place, then we turn around and implement the investment strategies that will help maximize their probability of success against their unique risks. So if you're an individual that is appropriate to be 100% fixed income, we establish parameters that, okay, if inflation heads at this level or your portfolio gets down here, we'll have to increase that risk. Now, I like to show this because so many investors are much more aggressive right now. It always happens at the top of the market because all they can think is, hey, it is different this time. But one common theme, and this is what I saw back in the year 2000, is so many investors had given up on bonds, they'd given up on value stocks, and they didn't want to be in a 70-30 equity portfolio because they felt like this was going to go on forever. They went to a 100% equity portfolio. We think that we can get wiped out going back to the Great Depression. Okay, but in this scenario that I have highlighted right here, if an individual is 70, had $2 million, increased it at 3.5% a year inflation, and was a 100% equity portfolio, and they retired in the year 2000, they would have run out of money at the age of 90. So if they lived beyond the age of 92, they would have been in trouble. And nobody anticipated that would happen back then. So this isn't just a phenomenon that goes back to the Great Depression, this thing in the past that we think that we'll never see again. It goes all the way back to the year 2000. So we don't even have to have this massive Great Depression for people to be unsuccessful right now, because most people don't realize the risk that they're carrying in their portfolios. They're just kind of partying like it's 1999 without the realization that the stock market was getting ready, the S&P 500 was going to go sideways for the next 14 years. So
now, Paul.
Yes.
3.5%. Let's say I'm a little more bearish than that. Let's imagine that I don't believe the government's 3.5%, but let's just say my personal experience looking at property taxes, looking at prescription drug prices, looking at my grocery bill. Let's imagine that I actually think, for some weird reason, that my inflation is twice that. Now what happens?
Well, I don't have twice that at 7%, but I was prepared for that. I've got 5.5%. So one of the things we do with clients, I take everybody through 3.5 and 5.5. And then some people I take through 7.5. The problem is most people would have to dramatically alter their lifestyle at 5.5, at 7.5, but 5.5 can do a lot of damage. So let's go back and look at this scenario. $100,000 a year at 3.5%, very conservatively invested, had a 65% probability of success, versus that same allocation at 5.5. Now they're at 34. So how many of you would walk outside the building that you're sitting in or the car that you're sitting in if they told you that you've got a 34% chance of survival and a 66% probability of being struck by lightning within the next hour? I don't know about you, Chris, but I'd sit in my car for the next hour, right? Yep. Now, where you were at 95% before in a moderate growth portfolio at 3.5% inflation, now you're at a 79% probability of success. So you are more successful in a more aggressive portfolio at 3.5 and 5.5% inflation, but you still have to consider that situation and build in some extra alternatives. So what would I do? And if you're at 100% equity portfolio, you're at 74. So 5.5% inflation can be absolutely devastating for those who haven't planned for it and haven't prepared for it. So what I try to do when I'm working with clients, go ahead.
No, I'm sorry. I just want to see some of those spaghetti charts there. Maybe for the 34%. I mean, are we crashing and burning 10 years into our program, or is it like what's happening?
Oh yeah. Let me go back. I hit the moderate growth, so I'm going to have to go back just as soon as this is done here.
Well, we can look at that one. That's fine.
So I'm here. Yeah, 34%. So the interesting thing is this is representative interest rates actual interest rates throughout history, for 60% of those funds being in intermediate term government bonds and 40% being in short term government bonds. So with the interest rates that were paid, earn, and let's assume that the government, continues to have a heavy hand over interest rates. In 1946, a 70-year-old would have used up all of their assets by the age of 87. Mm-hmm. And it, there's not much variability because it's a slow decline. Well, Chris, here's the same thing that I saw. I mean, I've had people come in 2014 and 2015 who bought 7% CDs in the year 2000, and they were giddy that they missed the market decline. And then by the time the year 2014-15 came, they'd had 0% interest rates for 4 or 5 years, but their cost of living had doubled over that period of time. And then they had to make massive revisions, and most of them had to make massive lifestyle changes, sell the home that they did hope that they would never have to sell, and downsize at the age of 80 because they were healthy and might live another 12 to 15 years. So yeah, you can look at that and see if it was the year 2002 and you were conservatively invested, because that's 2002 right there. And the reason that you would have failed is because interest rates hit zero for such a long period of time, and you had to increase your income. You're either going to have to use those assets up to maintain your standard of living, or you're going to have to completely sacrifice your standard of living to preserve those assets. Because of poor planning, there's going to be pain to pay at some point in the future for the individual who took this path in the year 2002. That makes sense so far?
It sure does. Yep.
Okay, so let's go look at that moderate growth. You can stop me, Chris, if I'm beating this to death. I love this data because I'm telling you, the clients that I take through and I do this with, they have a peace of mind, and they consistently tell me that they have a peace of mind. Not that they still don't worry about all the things, but they know that they've done everything that they can prudently do to put themselves in a position of success. So if we're at a 5.5% inflation with moderate growth, look at this. If the valuations that we have today, and you don't have a strategy that can reduce your risk, okay? So if you're passive, you're a long-term buy and holder, you're never going to sell, you're not going to make that mistake, okay? If you have convinced yourself of that and you're ignoring what's happened when periods of time throughout history that the markets have been this expensive, then right here's exactly what happened in 1929. Okay, I'm a long-term investor. I'm gonna buy and hold. Now you're down 70, 80% in the overall markets. And then by 1934, the market bounces a little bit. Then you have this big decline from 1937 and 1942. And then your portfolio's done and you're out of money by the age of 84, 14 years into your retirement. So what if you're 60? What if you've done great? Hey, I've been a great investor and I'm aggressive and I can handle this volatility and I'm going to retire at 60. And you're drawing 5% off of that portfolio and you have to increase for inflation and it's not completely different this time. What are you going to do if you're 74 and you run out of money because you weren't aware of what would have happened historically for that lack of knowledge? And not only that, you're talking right there's the year 2000, Chris. Mm-hmm. So if you were an investor that retired at 5.5% inflation in the year 2000, you're 60, you're out of money at 78. Guess what? I didn't have any clients that experienced that by God's grace, but I've talked to a lot of people that have come in and said, hey, is there some miracle that you can work? No, there's not. You got to sell your house and downsize or do a reverse mortgage or dramatically cut your standard of living. You can't take those trips you wanted to take anymore. And it's miserable. It's heartbreaking for me because I saw people that still had the health to be able to go do these things, but because they didn't understand history and they were convinced in the midst of that 2000 euphoria that it was different this time, and they've suffered the consequences. But those people get pushed to the back. You know, that's not somebody that CNBC brings on there because it doesn't sell stocks. It doesn't sell mutual funds. It doesn't sell. You don't hear about those people. And they're certainly not still at the country club telling you about what happens because they can't afford to be at the country club anymore.
Yeah.
So anyway, I hate to get on my soapbox, but right there is 2002. Right there is 1963.
Well, where's let's put 2000 on there. Can you find 2000 for me?
Yeah, right there's 2000. Can you see that, Chris?
That one, 2000. Yeah. So all the charts we just reviewed prior to this section, right, where we said it's not just expensive, but these are the most expensive ever. Our closest historical analog is going to be that red line right there.
Yep.
We're basically starting at that red line, only maybe even more expensive right now.
Correct. But everybody's expecting, because their advisors on the passive buy and hold side who don't study history and understand it are saying, hey, this is like 1975. You know, Trump's going to be just like Reagan was in 1982. We're going to be great.
Well, it's possible. It's possible. But your advisor ought to be able to answer the question when you say, tell me how I'm positioned the way I am. Tell me how that would perform historically, given current valuation levels.
Yes.
What are my odds? They should be able to answer that question. It's a very obvious question, right?
It is. It's a very obvious question. And unfortunately, it's something that our industry just doesn't do. And look, I understand that Monte Carlo analysis utilizes that, but Jeff, Manry, the creator of this program, and I tell him, I talk to him all the time. I'm like, what you have done and the program that you have created, I pray that I leave a legacy that's that impactful in people's lives, because the tool that he created, you know, going back to 1991, because he had seen so many problems of people coming out of the 70s. And even though the 80s were great, people were having trouble. So he was a student of the markets. You know, he explained how Monte Carlo even puts in some dampening of the volatility in there. And look, I can't tell you how many people have come in and I sit down with them and I'm like, look, you have an 80% probability of success if you retire today. And I don't feel comfortable doing that considering the markets are high. If this was 2009, I'd feel a little bit more comfortable because we've already got that overvaluation behind us, or maybe, 2000, 2002, 2009. And they're like, well, I went to so-and-so and they're telling me I've got a 95 or 100% probability of success. And I go look at it and it's a Monte Carlo analysis simulation. And look, I understand we have an unknown future. But if I have Monte Carlo simulation versus a historical rolling period analysis, I'm going to choose the historical rolling period analysis. And I can't remember the name of the individual. There's a famous mathematician, I can't think of his name right now, out of Canada, that's done a lot of studies on this, that I've got a couple of books, Unveiling the Retirement Myth and a few others that are powerful, that point this out. You know, and do you really want somebody giving you all kinds of sunshine and rainbows for your retirement? You want to have the reality of your situation and make those adaptations now. And I can't tell you how many times, there's two things that people don't know. When I send them the questionnaire, 90% of people send back, I really don't know how much I need to be able to live the lifestyle I want in retirement. Because what our industry does is says, go accumulate $2 million. You can draw 4 or 5% off of that and you're going to be fine. Okay, well, that's great on the data they're going back to 1975. But if you look at the rest of the story, I used to love Paul Harvey when I was younger. I love listening. And here's the rest of the story. Maybe that's what's wrong with me today, but that's it. But it helps me help clients. Let's put it that way. But the rest of the story is you have to assume perfection. So, you know, I get to meet with clients and I'll say, okay, here's where you are. And then they spend some time thinking about it. And once they understand how important that number is that they need to live on, they come back to me, well, I actually need a little bit more. Because what you don't want to do is get into retirement, think you can live on $100,000 a year and you're actually spending $150,000. So once we have that plan in place, the investment side's easy. I mean, don't get me wrong, it's stressful. Mm-hmm. especially in an environment like this. But those tools, it's pretty clear. When it says you need to sell as a fiduciary, we sell in lower risk, park it in treasuries. 2022, it had us reduce risk. I looked, Chris, to buy TLT in 2022, and it said, nope, TLT doesn't look good. So we parked it in money market, and we took a lot in treasury money market, and I took a lot of heat over that from some clients. But I just explained to them. I said, look, this is what it's telling us. Let's just wait and see how this unfolds. Give me 3 more months. Give me 4 more months. When I don't know what to do, we're going to park it in something safe. Mm-hmm. In hindsight, that was a good decision. And only with the benefit of hindsight do we know. The thing about doing this plan to help people prepare is we can use the benefit of hindsight and estimate to the future, so we can say, okay, what type of environment is it historically that would have wiped you out and caused you to be unsuccessful? And Chris, we just showed the exact same type of environment we're in right now is the one that would have caused people to be unsuccessful historically. So you have to assume that it's completely different this time. And if somebody chooses to ignore it, I mean, I've had clients that have had a 50% probability of success, and I'm like, I would not retire if I was you. And they're like, hey, I'm good with a coin toss. Okay, well, now we know. I know what I got to deal with. And here's how we're going to, help you walk the path that you're comfortable walking on.
Welcome back, everybody. Thank you very much for listening to that part. I'm always so impressed with what Paul does. Remember, if you want to talk to Paul and or his team, please go to peakfinancialinvesting.com, fill out a very simple form, and somebody from his office will be in contact with you within 48 business hours to set up that appointment. I highly encourage you to do that now before the markets start correcting, because there's going to be a little bit of a rush when that happens. A great time to begin the planning process, and it takes a little bit of time. More if you have a more complicated situation. So it takes time to go through the planning process. What Paul does is really just wonderful, comprehensive, thoughtful, judgment-free, all of that. He's just absolutely brilliant at what he does and how he trains his team to follow the methods that he's just a master at. So with that, thank you very much for listening. Again, go to peakfinancialinvesting.com, fill out that form, and you begin the process. I encourage you to do that. Until next time, I'm Chris Martinson, and please have a very, very wonderful weekend and enjoy the last few days of summer. Bye for now.